Now, global financial markets are focused on one critical question: what will the Federal Reserve do next with interest rates? Investors across the world are watching every new economic report, every statement from Federal Reserve officials, and every signal coming out of Washington, because the impact of U.S. interest rate decisions is immediate and global. At this moment, the market is deeply divided. On one side, many investors believe the Federal Reserve could begin cutting interest rates later this year, as signs of economic slowing emerge and inflation shows early indications of easing. On the other side, there is growing concern that inflation, particularly in services and wages, remains too strong, forcing the Fed to keep interest rates higher for longer. This lack of consensus has created an environment of elevated uncertainty and extreme sensitivity, where markets react sharply to even the smallest piece of new information. The Federal Reserve is facing one of the most complex policy decisions in recent history. If it cuts rates too early, inflation could accelerate again, damaging the Fed's credibility and creating new imbalances in the economy. If it keeps rates high for too long, economic growth could slow significantly, increasing the risk of recession and financial stress. This dilemma is at the center of today's market volatility. U.S. stock markets are reacting accordingly. Equity prices have been swinging sharply as investors constantly reassess expectations for future interest rates. Technology stocks and growth-oriented companies, which are especially sensitive to borrowing costs, have shown the most dramatic movements. When markets sense that rate cuts may be coming, stocks tend to rally quickly. When expectations shift toward higher rates for longer, those gains are often erased just as fast. This rapid back and forth has become a defining feature of the current market environment. The U.S. dollar is also playing a central role in this story. Expectations of prolonged high interest rates have supported a stronger dollar, attracting global capital seeking safety and yield. A strong dollar affects global trade, puts pressure on emerging market currencies, and influences inflation around the world. Conversely, when investors begin pricing in future rate cuts, the dollar typically weakens, providing relief to emerging markets and boosting risk-sensitive assets. These currency moves are closely watched, as they often signal broader shifts in investor sentiment. The digital assets such as Bitcoin are highly sensitive to global liquidity conditions. Whenever markets anticipate easier monetary policy, cryptocurrencies often surge as investors seek higher risk opportunities. However, when expectations shift toward tighter financial conditions, crypto markets can experience sharp and sudden declines. This dynamic has led to heightened volatility in the digital asset space, with prices responding almost instantly to changes in interest rate expectations. At the same time, investors are closely monitoring key U.S. economic indicators. Inflation data, employment figures, wage growth, and consumer spending reports are all being analyzed for clues about the Fed's next move. A single data release that comes in above or below expectations can quickly change market narratives and trigger major price movements. As a result, volatility has become the new normal. Markets are no longer reacting only to current economic conditions, but to expectations about future policy decisions. Short-term sentiment now plays a dominant role, and price movements can be driven as much by perception as by fundamentals. This uncertainty is unfolding alongside rising geopolitical tensions and ongoing global conflicts, which further complicate the outlook. Together, monetary policy uncertainty and geopolitical risk are creating an environment where market stability is